Oh, okay, perfect. I'm happy to be with you guys today. My primary goal is for you to pursue and achieve your financial goals. And a big part of that is through education. I believe that by learning more about the products available to you, you're going to be able to see your big financial picture. I am going to point out that I'm not going to be able to answer questions about a specific stock or holding today during the presentation because there are many of us here tonight and individual investor needs are going to vary. I don't want anything I say about a certain product or investment to be construed as a recommendation. So, that being said, if you do have a specific question about a stock you currently own, you're looking at purchasing, just questions you have about a specific product, you can come to me at the end of the session after everyone's gone, or you can call me directly. I will put my number in the chat. Okay, so that being said, I mentioned wanting to address your big financial picture. So let me make sure, just give me a thumbs up, Catherine, if you can see my screen change. Okay, so you should all see a drawing of an elephant on your screen. You may have heard this analogy before. Individuals were blindfolded and they're put in a room with an elephant. They're asked to touch and identify what they felt. So the first touched the elephant and they thought it was a tree because of the bark-like quality. Others felt the tail and they thought it was a rope. So the point of this is because these people were only experiencing and understanding pieces of information available to them, as opposed to that big picture I've been mentioning, they were mistaken about what was in the room with them. So investing is kind of like that elephant. Understanding that big picture is going to help you understand the different components of the strategy. So this discussion tonight is going to be part of an ongoing conversation about investing. It's designed to give you a little bit of better knowledge about one of the more common investments out there, stocks. We're going to be covering a lot of information tonight. So as Catherine mentioned, if you do have a question, feel free to write it down. You can bring it to me at the end. If you write it down as it goes along, I don't want to throw too much information at you and then you forget it. So if you've joined a presentation with us at the library before, you are familiar with my key steps towards achieving your financial goals wheel. To understand if stocks fit into your strategy, you're going to need to first understand your goals to see if it's an appropriate approach to you. Maybe it's not. So making sure that you're regularly reviewing your portfolio, make sure that there's no shortfalls and that you are on track. It's a very important component to investing. So let's get into the stock basics. Maybe you're joining the Zoom today because you would like to purchase stock, or maybe you already own stock. You could become owner of shares through an inheritance. Maybe you are part of an employee share plan. In these situations, you could easily find yourself with stocks that you don't know much about, and maybe that's why you're here. So stocks are can be referred to as equities. Equities is just another way of saying common stock of a corporation. And if you look up the definition of equity in the dictionary, you're going to see one of these definitions. It says, a risk interest or ownership right in property. So let's take some key takeaways from that definition of equity, specifically risk and ownership. I think it's important to point out, especially with investing, that any investment has the potential to make you money, but it also is associated with certain risks. Some stock investments will fluctuate with changes in the market, and it could be worth more or less than what you originally purchased it for. What about ownership? So you're likely familiar with the company Disney. Years ago, Disney, like other companies, used to issue a paper certificate when you bought a share of company stock. So I actually have one here for you to take a look at. So this would be an example of a share certificate. It's blurred out right now because of the Zoom, but that's a share certificate for you. And when people would purchase this Disney stock, they would frame it, they would hang it in their children's room. Now companies issue shares now digitally, but it's interesting to think about what that stock certificate symbolized. For the people who possessed that stock and they had that piece of paper and it was hung in their room, they owned a piece of the Disney kingdom. It's a very, very small piece, but it's still ownership. So that's what stock is. It's a piece of ownership in a company. Why do companies issue stock? It's a way for a company to raise money. Sorry about that, guys. When you decide to purchase stock shares in a company, the ownership also comes with some privileges. So as we're getting into the features of stock, I'm going to mention that there are actually two different types of stock. You have common shares or you have preferred shares. Common is the first type of stock that a corporation is going to issue, and not all corporations issue preferred stocks. Common stockholders are owners with a vote. As a common stockholder, you can vote on stock splits, company mergers, director elections. If you own stock now, you may have received letters in the mail asking you for your vote, and you would have thought, what is this? You have one vote per share as an owner of common stock. Preferred stock trades on the stock exchange just like common stock, but preferred stockholders are not entitled to the right to vote. Instead, if you have preferred stock, you have a preference over common stock with both dividends paid and if a company goes bankrupt and they have to liquidate its assets. So a company with both preferred stock and common stock has to pay dividends promised to preferred stockholders ahead of common stockholders. Sorry, I'm just going to mute so I can. I did warn you that I'm going to talk a lot today, guys. It's around half an hour, but then we'll get to the questions. So in most cases, when people are talking about stock, they are referring to common stock, and the majority of stock is sold and issued in this form. Okay, so how stocks make money. That's why we're here. We want to learn how to make money through stocks, right? And I was mentioning dividends. So let's jump into the two ways you can make money through investing in the stock market, in stock. So we have capital gains, or also could be referred to as capital appreciation, and dividends. Capital gains would be if you are, let's say, buying at 10 and selling at 20, that $10 spread, that would be your capital gain. That is the capital appreciation of the stock. I mentioned dividends, but what are dividends? So dividends are payments given to shareholders out of a company's earnings. Usually they're paid out quarterly. It could depend on the different stock. There are companies out there who have been paying their shareholders dividends since the 1800s. If you are the owner of a dividend paying stock, you're going to be paid at a rate set by the company. If you have questions about specific dividend paying stocks, I would be happy to address them at the end of the presentation. We're going to get into dividends a little bit, again, a little bit later on as well. But now that we've covered the basics, I want to talk about strategy. So there are three principles to keep in mind when it comes to investing: quality, diversification, and long-term perspective. This is especially integral to what I do at Edward Jones. So let's talk about how I define a quality stock. What characteristics make up a quality company? There are over 65,000 stocks available to trade globally, and so no wonder it could be difficult to choose the right one for your portfolio. We define a quality company as one with a long track record of growth and performance. They're well managed. Typically, they share their growth with shareholders through that capital appreciation, capital gain, or through rising dividends, like I mentioned before. And often they have a monopoly in the market. What does that mean? It means that they're leaders in their industry. If a competitive newcomer were to come along, it would be hard for that competitive newcomer to affect their value. Some stocks, some companies might come to mind for you right now. If there was a newcomer in the market, it will be hard for that newcomer to affect the existing value of the company that already has a monopoly of the market. And why do you want to focus on those quality companies when you are stock investing? It's because historically They hold their value better than other stocks during market declines like we're feeling now. When the market goes into a dip, you may still receive your dividends, even if your overall portfolio declines. So how do you uncover the quality? As I mentioned, those 65,000 stocks. I'm going to speak to our process. So if we first filter stocks based on geography. It says risk on the screen here. That's your credit rating, the company's credit rating, the size, and other quality criteria. And then from that group, if you're doing your own research, ask yourself, what companies have sustainable competitive advantages and strong financial positions? And then lastly, do an analysis on the valuation of the stock. So you could look up a fair value estimate of a stock. Let's say the fair value estimate of a company is 230 and it's trading at 130. That $100 is that capital gain that you'd hope to receive from investing in that stock. Okay. There is software available out there for you if you are interested in doing your own research, or you can partner with a financial advisor who has access to do the research for you. That said though, nobody has a crystal ball. Not all stock does what we expect, and this is a key reason why you should be diversified in your portfolio. Diversification. So diversification is the concept of not putting all of your eggs in one basket. Again, if you've been on a presentation with me before, you are probably familiar with me talking about my diversification elevator. Your screen shows a bridge. It's the same thing. I want you to imagine an elevator is only being held up by one cable. If that cable gets damaged, the elevator is going to go down. If the elevator is being held up by multiple cables, even though we have one cable that's damaged, we have the other cables keeping the elevator steady. So in this situation, the cables are the different stocks in your portfolio. That elevator is your portfolio. If you have one holding that's not doing too well, it's underperforming, you have the other stocks in your portfolio to keep you afloat. And that's why diversification will help you to reduce risk. There are multiple diversification strategies out there. You may have heard of a few of them, so let's break those down. Let's see here. I have my handy dandy pyramid that you may have seen already before with me. So one type of diversification is owning investments within multiple investment categories. These investment categories are referred to as your asset classes. So at the lowest level, we have our cash. This would be our savings accounts. This is your day-to-day money. You're likely not investing this money. If you are earning anything on this money, it's a small amount of interest. It's likely not a lot. As we work our way up the pyramid, we have our income. So income would be GICs and bonds. These investments typically provide a consistent level of return and provide stability in the foundation of your portfolio. Dividend-paying stocks are generally classified as growth and income because of that capital appreciation and dividend income that we spoke about previously. They aren't classified as income because the income you receive from dividends depends on the stock's performance. They're not contractually obligated to pay you those dividends. The higher up you go on the pyramid towards growth and aggressive stocks, the more your level of risk increases. So that means the greater potential for loss of capital, but the trade-off is potential greater returns. You can decide on how much risk you take in hopes of achieving your goals. So what you decide on your ability, your desire, and your need to take on that risk, that's what we consider your risk tolerance. And the process of putting all of your assets in these investment categories is referred to as asset allocation. You can diversify your account by industry. Do you see how no one individual industry makes up a whole amount of your portfolio? The reason for this is that no one can predict the future. As I said before, I don't have that crystal ball. And even quality companies can struggle sometimes. I want you to think of drug recalls, for example, environmental factors. So that's why having a diversification by industry is important. And I also recommend diversification by sector. Industry sectors behave differently during economic and market cycles. So depending on a sector's sensitivity to the economy, your stocks can be geared for playing either offense or defense in a portfolio. The earning potential of companies within the offensive sectors tend to be closely tied to the economy, whereas defensive sectors are not as sensitive to the ups and downs in the economy. So when we're feeling a struggle in the economy, we're in that recessionary period, those defensive stocks will help keep your portfolio afloat in theory. And that's why when building out a portfolio of stocks, we recommend maintaining a balance between offensive and defense. If you are unsure of how your current stock holdings are classified, you could ask any financial advisor to do an analysis for you, ask your own financial advisor, and the reason being, we'll get into the reason being a little bit later on. Diversification by market, by company size. So company size is also a component. If you've been listening to the radio at any given time or Bloomberg, you may have heard the term small cap, mid cap, large cap, and wondered what it meant. This is market capitalization. So it's a company's number of outstanding shares available multiplied by its current share price. Depending on a company's market cap, they may be more or less affected by events in the market. So a small cap company may be more affected by events in the market than a large cap. So let's walk through a couple of simplified examples of diversification, and here. Okay, so on your screen, you should see technology stock declines and consumer staple stocks rises. The benefit of owning stocks in different industries is that their performance may not be directly correlated to one another. And that's what I was mentioning before with those offense and defense. For example, consumer staples and tech are not correlated. If you have one stock in each company and tech declines while consumer staples rises, one's growth may have the ability to offset the negative impact of the other. So you may yourself believe yourself to be properly diversified when in fact your holdings tend to trend in the same way during market swings. So it's important to keep that in mind. Here's another example of something that could be happening in your own portfolio. So let's say all of your investments are doing fine, but one is consistently doing better than the rest. What do you think is going to happen to your portfolio? We talked about the importance of carrying a certain amount in each industry, maintaining a proper asset allocation. In this example, it may start to overweight your original selections and cause you to take on some unintentional risk. Now you're out of balance. So in this example, we could do a few things. We could add money to your portfolio and rebalance that way, make sure you're properly allocated, or you could sell off or trim some of the profit from stock D and rebalance it elsewhere where you're maybe a little underweight in something that's underperforming. When something's underperforming, I want you to think of it maybe, let's be optimistic, it's on sale. Things are on sale. Maybe we should buy more, depending on your own risk tolerance and your own portfolio objectives. So let's circle back on that concept of rising income I mentioned earlier, that dividend, those dividends increasing that I mentioned earlier. So these are your dividend paying stocks that have the potential to increase their dividends over time. If you are doing your own research for stocks, you should be able to look up the dividend rating. It could say dividend rating rising. It could be at risk. So make sure you're taking a look at that as well, especially when it comes to rising income. The reason I say this, it's hard to say how much milk, bread, eggs are going to cost in the future. If inflation stays around its historical average, the price for everything will double in about 25 years. Having rising income in your portfolio is going to help fill that gap between your predictable income stream and the rising prices. And again, I mentioned before, if you have those quality companies in your portfolio, even when the market is going down or doing not so well, you could potentially still receive those dividends. I also strongly encourage a long-term perspective. You've probably heard this referred to as a buy and hold approach. With this method, you can make money through price appreciation, through receiving dividends. It doesn't mean buy and forget. You still have to emphasize the importance of quality and reviewing your portfolio at least annually. And why am I even making the suggestion about long-term strategy buy and hold? Because of timing the market. So you may have heard about timing the market. It's when an investor buys and sells stocks that when they think that the time is right. You hope to buy as low as possible and sell as high as possible to chase the most capital gain. And that's the name of the game. That's why we invest. We want to buy low and sell high. We're all in this together. We're all trying to do the same thing. But usually too late, market timing investors realize what I spoke about earlier. There's no way to accurately predict what's going to happen in the future. So this example looks at $10,000 hypothetical investment from 1998 to December 2019. You can see that if you had missed only the 10 best days in that 21-year time span, you would have cut your returns by almost half. If I were to ask you all today, what will be the 10 best days in the market for the next 20 years? We don't know. No one knows. We don't have that crystal ball. So that's why I say it's about time in the markets, not timing the markets. But that being said, staying true to that strategy can be challenging during times of volatility. One strategy I use with my clients, especially those who are just starting investing, is to use systematic investing. If you're new to investing, this could be a way for you to wade into the waters and to get started. It's a process of investing a fixed amount at regular intervals. It's also referred to as dollar cost averaging. It doesn't guarantee a profit, but it allows you to buy more shares when the price is low and fewer shares when the price is high. So typically that averages out to be a lower average cost per share. I'm going to show you an example. All right. So this chart shows $5,000 lump sum at $20 a share. You've given me $5,000. The price per share that day was $20 a share. You were able to purchase 250 shares. Versus if you were to divide that $5,000 by 12 months, you are now investing $417 a month at various market prices for a year. That dollar cost averaging strategy got you 300 shares at an average price of $17 per share. It's a simple way to take advantage of market declines because it allows you to buy more shares when the price is low. Okay, so I'm not going to touch upon this too much today because our session today is trying to learn a little bit more about stocks. But it is important for you to know that you may already own stock and not realize it in the form of mutual funds and ETFs. So a mutual fund or an ETF, it's like a fruit salad where these products are the bowl, the mutual fund is a bowl, and the stock inside this mutual fund makes up the fruit. So therefore, if you own mutual funds, you may already be invested in certain companies. So make sure you are doing an analysis of your own portfolio so you understand. So an ETF tends to be a passively managed product, meaning that it seeks to earn the return of a certain index. If you own an ETF now, it should mention the ETF, the index it's tracking in the name. It's trying to earn the same return, nothing more and nothing less. It's passively managed. A mutual fund is actively managed, meaning that the stocks held inside that mutual fund are traded often. They're trying to to beat the index. If you have questions about your mutual funds or ETFs, again, end of the session, you can go ahead and ask. But that being said, I have covered a lot of information today. I felt like I've been talking a lot, so thank you very much for sitting with me. I'll do a quick recap before I open up the floor to the questions. We've covered the basics of stocks, including the types. We know about dividends and features. We know that, again, if somebody says they own stock in a company, they likely own common stock. We talked about how to make money. And the importance of quality, diversification, and that long-term strategy. So I am opening the floor to questions, and thank